So today we're going to have a look at what's been going on in the market and some data that's come out in the last week. We're then going to take a look at central bank activity over the course of the last week or two, and we're going to finish by looking at what this all means for portfolios and performance. So after a lot of strength in the markets in the last couple of months, the last week has been fairly subdued. We have had some good numbers out from around the world. We've had some softer inflation figures in the US, which may leave the door open for a delayed rate hike. In the UK, we've had some strong employment numbers, some surprisingly strong retail sales since Brexit, and also we've seen a rise in inflation in the UK from 0.5 to 0.6, but the outlook for rates in the UK remains firmly lower for longer. So following on from this low interest rate environment, we did see a couple of weeks ago the Bank of England cut interest rates for the first time in a very long time from 0.5 to 0.25. This is a new all-time low ever in interest rates in the UK. And also that we saw an introduction of quantitative easing, which included corporate bond buying program for the first time ever as well. So against this backdrop of very low interest rates, we've also got very low inflation, low growth. What does this mean in terms of portfolio performance? And we're delighted that performance has been extremely robust, both absolute and relative. That means that in a typical tailored portfolio service mandate, in the balance profile, returns are up in the region of 10% year to date. It also leaves us at the top quartile against our peer group. So that's in the top 25%, not just year to date, but over a 2 and 3 year period. And going forward with about 10% of cash sitting in portfolios, we're looking to deploy that in sensible risk-adjusted manner going forward.